Hi, I'm Professor Suneel Maheshwari with the Department of Accounting at Indiana University of Pennsylvania. Today we'll be talking about the common stock and preferred stock. This is part of the shareholders' equity in the accounting equation, assets is equal to liabilities plus owner's equity. So when we talk about common stock and preferred stock, we will go over the various rights that are associated with the ownership of these stocks, as well as we will look at the journal entries to account for these stocks. Here is an example of a share certificate, or which represents a part ownership in the company. The share certificate shows you the name of the company, the par value, and the name of the shareholder and number of shares held by that shareholder. As far as the number of shares is concerned, it is divided into three categories. You've got the authorized stock or authorized number of shares. These are the maximum number of shares that the company can issue under its charter. Then the company may or may not issue the entire authorized stock, although they are authorized to do it, but they might issue a little bit less than the authorized stock if that money is not needed. And the third one is the outstanding number of shares. These are the number of shares which are bought or paid by or owned by the stockholders. And this may be less than or equal to the number of shares issued. Generally, the outstanding number of shares is used to compute the ratios like earnings per share. As far as the common stock is concerned, there are two kinds of stock which are there, common as well as preferred. And common is the most basic kind of stock, or which is issued by the company. And it has various rights which are associated with it. And shareholders of the corporation will benefit maximum with the common stock, and at the same time they take the maximum risk when they own the common stock. In terms of preferred stock, they are called preferred because they have certain advantages in terms of receiving dividends first and receiving assets if there is a case where a company has to be liquidated. Sometimes shareholders can earn a fixed dividend and when they are preferred stock holders. In terms of right, the stockholders have the right to vote. Second, the stockholders have the right to receive dividends in proportion to their ownership. And third, in terms of liquidation, the stockholders have the right to receive a proportionate amount of assets if the corporation is liquidated. Also, the stockholders have the right to maintain their own proportionate ownership in the corporation. Stockholders' equity consists of two parts, the paid-in capital and the retained earning. Paid-in capital is also called the contributed capital, and this is the amount which the shareholders contribute. It includes the stock accounts and any additional paid-in capital. We'll talk about the additional paid-in capital a little bit later. Now, retained earning is the cumulative earnings or losses of the company throughout its life. It increases when there are profits in the company, and it is reduced by the dividends declared. Please note that the dividend is not an expense, and once declared, it is a return of shareholders' money back to the shareholders. So it reduces the stockholders' equity. In terms of the comparison between the common stock and preferred stock, for the common stockholders, the company doesn't have any obligation to repay the principal. Same thing with the preferred stock. But if you look at the long-term debt, the company needs to repay that long-term debts. In terms of dividends, dividends are not tax deductible for the common stockholders. Again, same thing for the preferred stock. However, the interest that the company pays on the long-term debt is tax deductible. So if you note the differences between the long-term debt and the common stock and the preferred stock. For the common stock, in terms of dividend, company is only obligated to pay them the dividend if it is declared. Similarly, for the preferred stock, the company owes dividend if it is declared. However, as far as the fixed interest is concerned on the long-term debt, it needs to be paid by the company. In terms of stock, a stock could be a par value or it could be a no par value. Par value of the stock is an arbitrary amount generally kept at a lower level so that any legal issues can be avoided. The par value of the stock has no relevance or no relevance to the market value of that stock. No par stock basically have no stated value. When you issue a stock, how do you make the journal entry? For example, Home Depot needs to raise $100 million through issuance of stock. That is issued at $10 per share, 10 million stock. In that case, the journal entry is cash debited, 10 million shares for $10 for a total of $100 million at common stock. And that common stock is created by $100 million. In this case, the stock has been issued at the par value, that is $10. Now, if the stock is issued anything over the par value, then what happens? Suppose the common stock has a par value of 5 cents and company needs to raise $100 million. The entry for the issuance of 10 million shares will become cash debited for $100 million. The common stock is created at the par value, that is 5 cents times the 10 million shares. The remaining goes to the paid-in capital, sometimes also called the additional paid-in capital, for $99,500,000. So please note that the common stock is created only with the par value of the stock. Remaining amount is put in the account called paid-in capital. Both are part of the stockholders' equity. So if you look at the shareholders or the stockholders' equity, you've got the common stock at par for $500,000. So in this case, you notice that authorized 10 million, and those are the same number of shares issued and outstanding. Paid-in capital is the remaining $99,500,000, and the retained earning is given to you at $500 million, total of $600 million of stockholders' equity. Now, if it was a no par common stock, for example, 16,422 million, the entry is just cash to common stock. There is no paid-in capital over here because it is issued at no par stock. So in this case, you've got the common stock at 16,422,000, and the other numbers are just given to you as part of the information. Common stock may be issued for something else other than the cash. For example, in this case, you're issuing 15,000 shares, which is $1 par common stock, with a market value of $4,000 for the equipment, and for a building with a market value of $120,000. So in this case, instead of cash, you're getting equipment worth $4,000 and a building worth $120,000. So both of those are debited as they are increasing. The common stock is created with the par value, that is 15,000 shares have been issued in lieu of the equipment and the building. So the common stock gets created by 15,000, and then you've got the additional paid-in capital in excess of par is the remaining 109,000. Similarly, we can issue common stock for services. In this case, you've got to pay some legal expenses worth $25,000 with 2,500 shares of common stock with $1 par value. The fair market value is $10 per share. So legal expenses $25,000, common stock 2,500 shares times 1, which gives you $2,500, and the balance 25,000 minus 2,500, which is 22,500, is credited to the paid-in capital in excess of par. And the legal expenses debited as it's an expense, and there's an increase in expense. So we paid off those legal expenses by issuing the common stock. Preferred stock, as far as journal entries are concerned, they follow a similar pattern, and they may have separate account for paid-in capital in excess of par for preferred stock. Instead of just saying common stock, it will say paid-in capital in excess of par for the preferred stock. Some of the preferred stock have conversion features. That is, it allows the preferred stockholders to convert their shares into common stock if at a certain point of time or at a certain price. So here is a convertible preferred stock of $1 par, 50,000 shares issued at par value. So if you issue the preferred stock at par value, you've got the cash to convertible preferred stock, $50,000 credit. Now, here is the preferred stock which can be converted into cash. So the ratio of conversion is 6.25 is to 1. So 8,000 shares of $1 par common stock were issued in exchange for 50,000 shares of preferred stock. So please note that we debited the convertible preferred stock by 50,000. Then the common stock, 8,000 common stock that were issued is 8,000, and the remaining goes to paid-in capital in excess of par for the common stock. Thank you very much for your attention.